Welcome back to Factful Finance, where we dive deep into the world of money, economics, and the strategies that shape your financial future. Now, have you ever stopped to wonder how global events far from your doorstep influence your investments, savings, and even the price of things you buy every day? It's a lot more connected than you might think. And today, we're tackling a big one: how geopolitics and trade wars affect global financial markets. Think about this. In the past few years, we've seen a rise in trade tensions between major economies, China and the U.S., for example. And these trade wars didn't just affect the countries involved. The ripple effect went global. Global financial markets, they were hit hard. But how does this all work? Let's break it down. Geopolitics is the intersection of global politics, economics, and geography. When countries start imposing tariffs, enacting trade restrictions, or engaging in sanctions, it creates a chain reaction that touches everything from corporate earnings to stock prices to interest rates. And in the world of investing, what happens in one part of the world can have a lasting impact on markets everywhere. Take the U.S. China trade war that started in 2018. At its peak, tariffs on billions of dollars worth of goods were imposed, leading to higher costs for manufacturers, disruptions in global supply chains, and shifts in investor sentiment. The U.S. stock market saw volatility, especially in sectors like technology, manufacturing, and agriculture. But it wasn't just about tariffs, it was also about market perception. When there's uncertainty, people pull back, and we saw that clearly in the market's response. One key principle we need to understand is the role of market sentiment. Financial markets aren't just driven by hard data like earnings or GDP growth. Perception plays a huge part too. For example, during periods of high geopolitical tension, investors tend to flock to safer assets like gold or government bonds. That's why during trade wars, you might see these safe haven assets outperform others. Investors look for stability, and sometimes the threat of conflict is enough to spark a flight to safety. Now, let's bring in some real-world scenarios. Meet Liam, an investor from the US who's heavily invested in tech stocks. When the US and China engaged in a trade war, Liam saw his portfolio take a hit. Why? Because many of his stocks were tied to companies that rely on Chinese manufacturing and exports. The price of tech products went up due to tariffs, which impacted demand. And as tensions rose, investors grew more anxious, leading to a drop in stock prices. But here's the twist. While Liam took a short-term hit, he also recognized that the trade war was an opportunity. Companies were being forced to rethink their supply chains, and those that adapted quickly were set to gain. So Liam shifted some of his investments to companies innovating in new markets. This brings us to another crucial concept: supply chain shifts. During trade wars, companies often move their operations to other countries to avoid tariffs, seeking lower-cost alternatives. This can benefit certain economies while hurting others. Let's say a company based in the US was sourcing materials from China. With tariffs in place, that company might look to Southeast Asia or even return manufacturing to the US. The ripple effect? Countries with cheaper labor, like Vietnam, saw a boom in manufacturing. It's also important to note the role of currency fluctuations. When trade wars heat up, countries often devalue their currencies to stay competitive in global trade. This can make exports cheaper, but it also means your international investments could see fluctuations in value. This impacts everything from the price of foreign goods to the returns on international stocks. So what does all this mean for you, the investor? First, diversification is key. When you spread your investments across different markets and asset classes, you're better positioned to handle the uncertainty that comes with geopolitics. If you're heavily invested in just one country or sector, a trade war or geopolitical crisis could significantly impact your portfolio. Also, keep a close eye on global economic indicators. Changes in interest rates, inflation expectations, and GDP growth are all tied to global political events. These indicators help investors assess the health of the economy and the stability of markets. For instance, when the US imposed tariffs on China, the Chinese government lowered interest rates to combat the economic slowdown. This move had global implications, from emerging markets to the US economy, creating both risks and opportunities. Geopolitics and trade wars are complex, but they're not unstoppable forces. You can manage the risk by staying informed, making data-driven decisions, and understanding how these global shifts affect your bottom line. If you found today's discussion helpful, hit that subscribe button so you don't miss out on more game-changing finance insights. And if you want to dive deeper into these topics, make sure to check out the video that'll pop up on your screen next. Trust me, it's packed with actionable strategies you can use. As always, this content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. See you next time, and remember, the more you understand how global events impact markets, the better equipped you'll be to make savvy financial moves.